Okay, welcome to my class. My name is Patrick Boyle. I'm teaching an Introduction to Derivatives class. The goal of this class is to teach you about derivatives, the various kinds available, how people use them, and what the positives and negatives associated with each of the different products is. So the first thing we're going to learn in this class really is just what is a derivative. We'll be looking at chapters 1 and 2 of your textbook. And I encourage you to read the chapters. They're written very clearly, and these video lectures are obviously designed to go along with them, but there's really a lot of benefit to just going through the textbook on your own, and obviously answering all the questions at the end of the chapters as well in order to really get good at this material. So, our first question, what is a derivative? And a financial derivative, our definition is that it is an economic contract whose value depends on or is derived from the value of another instrument or underlying. So it's quite different to something like a stock or a bond, which is a security that's issued by a company and that's really used in order to raise capital for a company and is part of the capital structure. A derivative is very much a side bet. The idea really just is that it takes a price from something else, but thus allows you to have sort of alternative payoffs. So payoffs that don't relate necessarily to the very long-term performance of a company, but that much more allow you to hedge or speculate on shorter-term price changes in that underlying. The derivatives that we'll be looking at are categorized usually by the relationship between the derivative and the underlying asset. So we have a number of derivatives that we'll be looking at in this series of lectures. Futures, forwards, options, swaps, credit default swaps, which is a credit derivatives, and CDOs, which are collateralized debt obligations. These are the types of derivative, and they have quite different payoffs to each other. We can also break our derivatives down into the type of underlying asset, because there are many different assets that you can base a derivative on. As long as there's sort of a clear price out there that we can look at, we're able to then create a derivative based upon that. So the types of things that people are most interested in are things like interest rates, equity or stock performance, stock index performance, bonds, commodities, and then things like credit spreads. So these are the big types of underlying assets, but in the real world there are many more underlying assets out there and many different types of payoff. It's really just the only thing restricting the number of derivatives out there or the type of derivatives out there are really customer interest. If people, want exposure to various risks, usually a derivative can be created that will give them the type of payoff that they want. So who then transacts in derivatives? The derivatives market is quite big, and there are a lot of different types of people who invest or transact in derivatives. We break them into groups. Hedgers are the first group that we'll talk about, and a hedger is not a hedge fund. Often people get confused that when we talk about hedgers that we're talking about hedge funds. A hedger is someone who already has exposure, who has a risk exposure to the price of a given underlying, and then uses derivatives in order to reduce that risk. So that could be a producer of an underlying. It might be, for example, a farmer who's growing corn, and he might need to trade derivatives on that corn in order to reduce his risk of suffering a big loss in a given year of producing. It could be a consumer, so that could be, going with the same sort of example, a company like Kellogg's that produce cornflakes. And so while the farmer would worry about the price of corn falling before it goes to harvest and gets sold, the Kellogg's would be worried about the price rising. So should the two of them transact with each other and fix a price in advance, that would be a form of derivative, and both of them would be hedging. One is hedging the risk of the price falling, and the other is hedging against the risk of the price rising. The next group we have are speculators, and speculators are really people who don't have a natural reason to be in that given market, and they're really there trying to make a profit. So that could be an asset manager, an insurance company, a pension fund, any sort of an investor who really is in that market because they feel they have maybe specialized knowledge or an ability to predict price movements and wish to profit off of that. So obviously, as you can see, a speculator has a very different motivation to being in the market than a hedger does. Now, quite often, hedgers and speculators will be transacting with each other. The next group we have are middlemen, and they are firms like investment banks and market makers, and their real function within the market, while they will be taking positions, their real goal in that market is just to charge a commission or a trading spread and profit from that. So they are never making sort of a long-term bet or even a medium-term bet the way a speculator would. They don't have anything to hedge. They're really just there to facilitate trading and make a profit based on charging a commission or a spread to everyone who transacts in that market. And then finally, we have arbitrageurs, and arbitrageurs, we'll kind of explain that a little bit in greater detail later on. But an arbitrageur is kind of a little bit different to all of our prior groups. They tend to be trading not to take an actual position in the underlying, but we'll say, for example, if corn futures traded on two different exchanges, one in Chicago and one in New York, and once in a while the price in Chicago went up and the price in New York lagged a little bit behind that, an arbitrageur would be stepping in there and trading the same product into two different markets, trying to make a profit out of that. But the trading of the arbitrageur tends to keep prices in line with each other. Should these people not exist, it would be quite possible for the price to be different in two different markets. Usually because these traders are stepping in, it ensures the law of one price, and it means that an investor is able to go to either of these exchanges and be reasonably sure that they'll get a fair price, because if the prices were unreasonable, an arbitrageur would hopefully be able to step in, take advantage of that, and their trading would push the prices closer together. So that's who transacts in derivatives. So that's kind of our quick introduction to derivatives and the description of what derivatives are. Now we're going to move ahead and discuss our first type of derivative. So the first type of derivative we're talking about is a futures contract. And a futures contract is quite a simple derivative. It's easy to understand. It's simply a standardized financial contract that obliges the buyer to buy an asset and the seller to sell that asset at a predetermined future date and price. The contract will specify in detail the quality and quantity of the underlying asset, and the contracts are very standardized. Thus, a regular trader of futures contracts knows exactly what they're buying and selling because of this standardization. So it's not a different contract every time. Usually the big difference between various contracts will be as simple as what their expiration date is. Some futures contracts will call for physical delivery of the asset. That means that if you, for example, bought an oil futures contract, you would be expecting, if you held until expiration, for someone to deliver physical barrels of oil to a storage facility with your name on them that you would have to pay up for in full at the agreed upon price. Others are settled in cash, and that really means that instead of the complication of physical delivery of an underlying, that you really just settle up the cash difference between the price agreed upon at inception of the contract and the price in the market on the date at the time that contract expires. So that's what a futures contract is. It's a fairly simple derivative. It's worth noting that it's called a contract because that's what it is. So when you buy a futures contract on, we'll say, a product like gold, it's economically similar to actually buying physical gold, but instead of you buying physical gold and storing it, you are agreeing on a price to buy gold at right now for delivery at some point in the future. And it is just that. It is a contract, a legal contract, and it will specify all of the details of that purchase or that sale, such that there's not really going to be any argument around what has been agreed on. So that is a futures contract, a contract to buy a given underlying at a price that's agreed upon now for delivery at some time in the future, which we call the expiration date. So when you buy a futures contract like that, obviously at inception, if you and I agreed that we were going to trade a product, I was going to buy it from you, you were going to sell it to me at a future point at a price that seems fair right now, there's no initial risk in that the price at inception is the price that's in the market right now. But obviously, as time goes by, if the price starts to rise, one of us has agreed upon quite a good deal that you're buying the product at a price agreed upon in the past, and the price has now risen. And so you might start worrying about the other person's ability to pay. And so for that reason, you have to put up an amount of money that we refer to as margin. Buyers and sellers of futures both put up margin because there is risk on either side. Now, you don't put up the full amount. So we'll say, for example, if we agreed on a futures contract on gold, and gold is trading at $1,000 per ounce, and we'll say, just for simplicity's sake, that we've agreed on a price that you will buy gold from me at $1,000 an ounce for 10 ounces. So that's $10,000 worth of gold. We don't have to put up that 10,000. You just put up enough money that makes a contract safe. So usually traders have to post an amount of margin between 5 and 15% of the contract's value. Now, that is put up to begin with. That's what we call an initial futures margin. As the price starts to move, one person will be winning, one person will be losing. And so the person who's winning, they are obviously quite a good credit because they're in a situation at that point at which they will be collecting money. The person who's losing, their margin is getting depleted. We'll say if they put up 10% to begin with and the price has moved 10%, the other party starts to worry about that. So what has to happen is that the margin has to be maintained. It has to be topped up. So on a daily basis, usually, if you are losing money on your futures position, you have to keep topping up at the end of day in order to maintain margin at the maintenance margin requirement. If you're unable to top that up, you get what's called a margin call, where your broker calls you up and says, you need to top up your margin by end of day, otherwise we are going to liquidate your position at the market price and crystallize your losses. So usually initial futures margin is higher than margin maintenance. And the reason for that is just that you don't have to keep topping it up, we'll say by a penny a day if it's moving a penny a day against you. But we'll say if initial margin is at roughly 10%, maintenance margin might be at 7%. So you're required to keep your margin at least at 7% of the outstanding value. So that is margin, and obviously, as I said, both buyers and sellers of futures have to put margin in. The next thing we're going to look at is just a payoff diagram, and our first payoff diagram is a very simple payoff diagram. It's almost not worth looking at, except that as we move along in this course, we're going to see more and more complicated payoff diagrams, and so in order to understand the complicated ones, we have to understand the very simple ones to begin with. So our first diagram here is a payoff diagram of the underlying. And as you can see there in the middle, we've got the investor's entry price, or S0. And that's the price that a person bought an underlying product at. So we'll say if it's a stock, if you buy a stock at $100, that is your entry price. And as the price of the underlying moves up, as you can see down at the bottom, the underlying asset price, as the price moves up, you start to see gains. And as the price moves down, you start to see losses. And if the price doesn't move at all, you've got neither gains nor losses. So that's our payoff diagram of the underlying. The next thing we have is a payoff diagram of being short the underlying. Now, I'll explain a little bit about long and short in a few minutes, and it's also well explained in the book. But the payoff diagram of being short the underlying, as the underlying asset price moves up, you start to see losses. And as the underlying asset price falls, you start to see gains. So someone who is short an asset wants to see the price fall, and they will profit from that fall, and they will sustain losses from a rise in that asset price. That is what being short the underlying is. The next two charts we have show the payoff diagram of futures. As you can see here in the first one, figure 2.5 in your textbook, that the payoff of being long a futures contract is essentially the same as being long the underlying asset, in that as the asset price moves up, you make money. As the asset price falls, you lose money. And it's a linear relationship. We've got a straight line there between the profits and losses associated with the futures price and the payoff of the underlying. And then equally, when we look at our short futures payoff, we have the same diagram essentially as the payoff diagram of being short the underlying. So as prices rise, when you're short futures, you're losing money. And as prices fall, when you're short futures, you're gaining money. You're making money. So that is the payoff of futures contracts. And the beauty of the payoff of these futures contracts is that it is the same as the underlying. So it allows an individual to trade the underlying without maybe the difficulties associated with buying and selling the underlying. And at first that may not seem like a great benefit to you, but in particular we'll say if the underlying is something like a stock, because you'd say, well, it's as easy to buy a stock as it is to buy a futures contract. But when we look at things like commodities, it's maybe a little bit more complicated to buy and store barrels of oil or gold, which you might have security issues around or whatever. And so when you trade these futures, you're able to log into your brokerage account, buy or sell these commodities, and you get the same payoff as if you had actually bought physical oil in barrels and stored it for later sale. But you're able to buy and sell this at a click on your computer, rather than the sort of complex procedures that I imagine are involved in buying and selling physical commodities. So, Futures contract specification. So what are the terms that are written out in a futures contract? So the futures contracts, they're all brought about from an exchange. A future is an exchange-listed derivative, and the exchange will come up with standardized terms for a futures contract. And if you wish to buy or sell those, you can then trade them on the exchange. So what are these specifications? Quite simply, the first thing is where and when delivery is made. So if it's something like oil or gold, where will this oil or gold be delivered to? And equally when, what is the expiration of this contract? Whether it will be delivered in physical form or whether there will be cash settlement on this contract will be agreed at outset. The contract size, so how much of this underlying you are buying and selling per contract, will be agreed. The expiration date will be agreed. And how the price is quoted will agree. So that even relates to things like the multiplier on the contract, which is explained in your textbook, and the minimum tick size. So how much the minimum rise and fall on a contract can be will all be specified in the futures contract. There'll be things in there like price limits. So many contracts have predetermined daily price limits. And what that means is a limit as to how much that contract that is allowed to move before the exchange halts trading or closes trading for a day. Now, the reason these price limits exist is really to prevent wild movements and it's to prevent an unruly market. And so if the futures move beyond large preset amounts, the exchange typically halts the trading. Sometimes it might be just for a short period, like, half an hour. At other points, it might be halted for a full day. So the example we have on your slide here is the S&P 500 futures limits. Now, this can change over time, but at present, during the overnight session, limit up is 5% and limit down is 5. And then intraday, there's just a 10% limit down. Now, by the overnight session, what we're talking about is that futures, in particular futures on the S&P 500, trade in almost a 24-hour market. It's about 23 hours because there's a couple of halts throughout the day. Now, the cash stocks that underlie the S&P 500 open in New York at 9:30 and close in New York at 4 p.m. New York time. So we call that the day session when the actual underlying is also trading, and then the rest of the time we refer to as the overnight session. So as you can imagine, the S&P 500 is much more liquid during, and by that I mean it trades greater volume and there are more traders involved in the market during the day session than there is during the overnight session. And for that reason, they have tighter limits overnight and they have this limit up move, this 5% limit up move. The intraday session, I guess the exchange thinks of it as maybe more valid for price discovery, and so they have a wider limit of just 10% down. And so what happens is that if futures prices move to those limits, they get temporarily closed and then usually reopened a while later with a new limit in place. And the reason for this is sort of to prevent things like crashes or extreme moves that might be caused by unusual, we'll say manias in the market. And the exchanges put these in place because they felt that traders maybe during a market crash get overly excited and make irrational decisions, and they feel that should they halt these from time to time, it allows everyone to sort of settle down, calm down, think a little bit, and then they reopen the market and they hope that maybe it'll be a calmer market. Now, these price limits are a little bit controversial because there's a lot of people who feel they shouldn't be in there at all, that prices should just move to whatever level the market market moves them to. And should it move to an irrational level, well, that just provides, greater opportunity for people with a level head who are making rational decisions. There are many that worry that as the price starts to move towards this limit, the traders might dump their position in order not to be stuck in a position. And traders do get stuck in positions with these limit type moves. For example, you don't see it too often hitting the limits in things like the S&P 500 futures, but in some commodities, things like coffee, there have been times when there's been, we'll say, 7 limit up or limit down moves in a row. And what that means is that the market opens, it moves to limit down, it gets closed, the next day they open it again and it actually just opens limit down and so closes instantly. And that can occur day after day. And that really makes it very difficult for someone to get out of their position if they want to, because there's essentially no price at which you can sell. The market has essentially seized up. So a lot of people don't like limits for that reason, but equally other people feel that they add a lot of value in markets and maybe prevent crazy moves from occurring. The next type of limits that we're going to talk about are position limits, and these are in place on the exchanges as well. And these are the maximum positions that one investor is allowed to amass in a given futures contract. The reason that these exist is really just to stop a big trader from trying to corner a market, which is something that has happened in the past. It used to happen quite a lot in the old days. These are in place in order to protect exchanges and clearing houses against bankruptcy and to protect investors against market manipulation by one big trader. So that's position limits, which are different to price limits, and it's important that you know the difference between those two things. Okay, so our next slide is on futures daily settlement and margin. So each day, both buyers and sellers adjust their margin, reflecting the profitability of their position. So we touched on this a few minutes ago. And what this means is that the trader who loses money, the trader who lost money, has to post more money on margin. So as you remember, they didn't put up all the money. If you bought a stock, you have to put up all the money usually to buy a stock. If you buy a futures contract, you usually have to put up only a percentage of that. But then as you lose money, you're required to top that up. Now, the trader who made money will see more money flowing into their account at the end of the day as the margin accounts are rebalanced. And as I mentioned earlier, if sufficient margin is not maintained in the accounts, the broker will close out your position, and this happens only really when you're at a loss. So that is how daily settlement and margins work, and this is just the nature of, because you're only putting up a percentage of the amount of money required to trade the position. This is needed in order to keep the market reasonable and to make sure that traders are treated fairly, and so that you can show that you have sufficient funds available to weather the kind of losses that you might sustain as a futures trader. So clearing houses are the actual counterparties on exchange traded derivatives. So when we have two people, one person, we talked about earlier when we said hedgers, and we might have the farmer might be selling corn futures and the producers of corn flakes might be buying corn futures, and they're each hedging a position. Now you might think that they are facing each other. If they happen to both, if one bought while the other was selling, maybe they even are to a certain extent facing each other. But as a trader, the counterparty to every trade is actually what's called the clearing house. And the clearinghouse guarantees payouts to all parties at maturity. And this allows us to not worry about credit risk really when we're trading futures. So we'll say, for example, during a big market event, like during the credit crunch, if you were trading futures and you were facing a large investment bank, you might worry that during the credit crunch that that investment bank might be a bad credit and you might be nervous about your position. But luckily, in between you and the counterparty is the clearinghouse. And the clearinghouse, they charge a fee on every futures transaction and they hold the margins. And so should the person on the other side of your cleared derivatives trade go bankrupt, because you're not really facing that person, because you're facing or trading with the clearinghouse will still guarantee your payout if you are the winner in that transaction. So that is clearing. Now, the next derivative we're going to talk about, we're done with futures at this point, we're moving on to forwards. And a forward contract is a non-standardized contract between two parties to buy or sell an asset at a specified future time at a price agreed upon today. So as you can see, this sounds an awful lot like a future, and the reason for that is that it is an awful lot like a future. The big difference here is that it is a non-standardized contract. So our futures were standardized contracts that were specified by the exchange, and they go through a clearinghouse and all of these other details that we've just talked about. A forward is non-standardized. So instead of being for a very standard amount of the underlying, it can be for whatever you would like, for any amount you like, or for an underlying that maybe isn't available as a listed future. And so this is what we describe as an over-the-counter derivative. It's not exchange listed, it's over-the-counter. It's agreed between the two counterparties. Usually it might be an investor dealing with an investment bank, and the investment bank creates this over-the-counter forward for our investor. Futures versus forwards. Futures are less flexible, but have the advantages of scale. So they're a big, standardized, easily understood product. They trade large volumes, and usually the trading costs are quite low. Forwards are much more flexible, but they require more paperwork. They're maybe harder to understand. There's less liquidity, usually higher trading costs, and often no clearinghouse. So I often try to explain the difference between listed derivatives and over-the-counter derivatives as being like the difference between a store-bought suit and a custom-made suit. And so a store-bought suit, you know, if you wanted to buy a suit, you could go into a big high street store, look up your size on the rack, find a suit that fits you reasonably well, and that is a bit like a future. It's a mass-produced product that suits you. You can find one that most likely will suit you. A forward is like a tailored suit, and it's really if you feel that an exchange-listed derivative is not appropriate for your needs, if you have rather special needs, you can have something made exactly the way you want it. You can have an over-the-counter derivative, in this example a forward, and it's really an awful lot like a future. The main difference being that it's over-the-counter and it's tailored for the specific needs of the investor. So that is futures versus forwards. The next thing we're going to move on to is order type. So when you're buying and selling futures and forwards or derivatives, how do you do it? So usually there's a list of different types of orders that you're able to enter in the market. The most simple one is called a market order, and that is essentially like if you just ask your broker to buy me this derivative at whatever price it's trading at in the market right now. So just give me the market price for this derivative. The next type of order we'll talk about is called a limit order. And that's really that you've put a limit on the price that you'll pay. So for example, it's really just if you're worried about overpaying or a sudden spike right as you're buying. So we'll say, for example, if the S&P 500 is trading at 1,000 and you wanted to buy a futures contract on that, you could say to your broker, I would like to buy one S&P 500 futures contract, and I don't want want to pay more than $1,001, for example. So that is a limit order, and you've put a limit on how much you're willing to pay. With the market order, there was no limit. You would have just paid whatever the going price in the exchange was when your order hit the exchange. Now, the next order is called a stop order, and stop orders are a type of order that are really starting to disappear. It sounds a little bit counterintuitive, but it is an order where you are saying that you want to buy if the price goes higher or sell if the price goes lower. Usually these are used in order to get someone out of their position. That's why it's called a stop order. We'll say, for example, a stop sell order is usually referred to as a stop loss. And how investors actually use them is, for example, if you had bought that futures contract at $1,000 and you're now worried about losing too much money on it, so you could put it in the order books, a stop order that says, should the price fall by $5, that you want to exit that position. So the most you're willing to lose is $5 on that. So you would put a stop order in the books that should the price fall by $5, that then throws in a sell order into the market. Selling at, it basically becomes a market order once it hits the market. So that's what a stop order is. They still do exist. Often they exist at the broker level now rather than on the exchange, because a lot of the exchanges have been doing away with that order type because they feel that it's not necessarily a great order for investors. After that, there are all sorts of, market and limit and stop orders are basic order types that are very common. Beyond that, there are all sorts of algorithms that allow you to buy in many possible ways. So two that we'll talk about quickly here are what's called VWAP and TWAP orders. These are usually algorithms that are designed by your broker, by your trading software provider, for example. And a VWAP order is a volume-weighted average price order. And then TWAP is time-weighted average price. So it's really an average price, and it just depends on whether you want it to be volume or time-weighted. And these are for, we'll say, very large investors. We'll say if you're a big asset management firm and you want to buy $50 million worth of a stock today, you don't want to just throw that in one big order. So you'll put it in an algorithm, and the algorithm will try to get you today's average price on that stock or on that future, and it'll be either volume weighted or time weighted. And so that's for an investor who just wants sort of to get what seems like a fair price. They want the average price for the day, and that algorithm will do its best to try and achieve that. Now, they're usually not guaranteed. It's very difficult to guarantee someone that you'll get them today's average price, but these algorithms are pieces of code that are designed to seek out either the volume or the time-weighted average price of the day. So they usually break up a big order and trade a little bit of it throughout the day, hoping to execute the whole order by close of business, giving the investor the average price. So that's order types. Once again, there are many more order types than I've discussed, and you can take a look at your textbook and you'll see sort of greater detail on that. So the next thing we're going to talk about is short selling, and it's very important to understand short selling in order to understand how derivatives work in general. I touched on it a little bit earlier, but short selling involves a mechanism. Firstly, why would you short sell? You usually short sell because you believe a certain security is overpriced, it's too expensive, and you feel that the price is going to fall and you would like to profit from that fall in price. So what you do is you have to find someone who will lend you that security. You're then going to sell it in the market to another market participant. So you've borrowed a security and sold it, so you are short that security. That's where the term comes from. You do eventually need to cover that, to buy it back in order to return it to the person you borrowed it from. And so later on, you have to buy the security, return it to the person you borrowed it from. Now, a lot of people think that you can just short sell, that there's sort of, that if you don't have a stock in your brokerage account, that you can just sort of click a button and sell it, and that is fine. But obviously that can't be fine with we'll say something like a stock, because whoever bought that stock from you needs to have it delivered to them, and if you don't have it, a problem exists. So that's why the borrowing process is in place. So that is what short selling is of a stock. Now, with futures, because they are a side bet, and most of our derivatives that we'll talk about, they're side bets on the underlying, shorting is a little bit different, because for anyone who is long a futures contract, there equally needs to be another person who is shorted. Now, they might be shorted because they're long the underlying as a hedge, so maybe they're not taking the full risk of being shorted. But for every buyer of a futures contract, there must be a seller. It's essentially a zero-sum game. It's maybe simpler to go short using futures in that you just have to find someone who's willing to take the other side of the bet from you with a futures contract, while with an underlying, you not only need to find someone who's going to take the other side of the bet, but you equally need to find someone who will lend you that security. Now, usually when you've borrowed that security, no one is going to lend you their stock and allow you to short it for no good reason. So usually you have to pay some sort of an interest rate on the borrow of a given underlying. So that is what short selling is. Our next slide here is on arbitrage, and what is arbitrage? And it's important to look and to understand this definition, because it's a term that's frequently misused by market participants. But when we speak about arbitrage, we're talking about an opportunity to generate a profit that is riskless by selling an identical asset for a higher price in one venue and buying it for a lower price at another venue instantaneously. So it must be a riskless profit. A lot of the time you'll hear someone refer to something as an arbitrage, but there is a risk within their trade, or they'll talk about an arbitrage between two similar assets, but it's not technically considered an arbitrage unless it is the identical asset. And finally, it must be done instantaneously. So you can't buy it in one venue and sell it in another venue 5 minutes later and call that an arbitrage, because obviously you were exposed to market risk for 5 minutes. Thus it was not a riskless transaction. So our example that we've got here is, suppose you can buy 1 ounce of gold electronically in London at $1,361. At the same time, you can sell 1 ounce of gold through a US broker at $1,363. If you can do that, you should theoretically be making a risk-free profit. So that is what we're talking about when we're talking about arbitrage. Arbitrages typically don't exist in the markets, or if they do, they tend to be small and taken advantage of by the fastest traders with the lowest trading costs. So typically, a retail investor will not be finding arbitrages in the market, because there are large high-frequency traders or broker-dealers who have huge server farms devoted to searching for these price discrepancies and trading automatically upon them. But that is what we're talking about when we say arbitrage in finance. Now, the next slide we're looking at is on interest rate conventions, and we have to look at this because it explains how we'll do all of our calculations for the rest of this 6-week course. Borrowing or lending $100 at a rate, we use the letter R for the interest rate of 5% for 2 years yields a payment at maturity of 100 times e to the Rn. Now, e is Euler's number that you should see on your calculator. If you don't know how to do that, it's worth looking it up online or speaking to a friend to show you how to use the little e function on your calculator. So 100 times e to the Rn gives us 110.5171. So that is continuous compounding, and that is what we'll be using in our calculations here. So it's good to have a good business calculator that you can work through these problems on, and that's that. Our next slide is on futures notation. So we'll use this notation in all of the problems that we look at. So T is time to delivery or time to maturity. S0 is the price of the underlying today. We also refer to that as the spot price. And then F0 is the forward or futures price today. So 0 being at time 0 right now. R then is the risk-free rate annualized. So these are the notation that we use both in your textbook and in the notes that you'll be looking at. So pricing futures and forwards. Arbitrage helps us to determine prices. So that's why we've run through that concept of arbitrage. Okay, so we're going to look at futures valuation now. And rather than me just present you with a formula, what we're going to do is work through an example of prices that could be out there and whether they would present arbitrage opportunities. And as we've just explained, arbitrage opportunities tend not to appear in markets, so usually someone would be trading in order to prevent wrong prices from existing. So we'll say if we have no formula, no idea what the futures price should be, but we know that there is a share in the market that's trading at $40. And we called up our broker and we said we'd like to either buy or sell a forward on that share. And the broker says, well, there's a forward out there that you can buy or sell at $43 and that expires in 3 months. So how can we tell if this is a fair price or not? Because we don't have a formula, so let's work it out. So the share costs $40 now. The interest rate is 5%, so we could borrow $40 at 5% for 3 months and use that money to buy one share. We could then sell a futures contract on one share, which is an agreement to sell that in 3 months' time. And as we've seen, that the futures price is $43, so we would be agreeing to sell that in 3 months' time at $43. After 3 months, no matter what happens to the share price, we don't actually at this point care because we're hedged. We've bought it and we've agreed to sell it at a fixed price. So if it goes up a lot or down a lot, it doesn't matter because our price has been locked in already. So after 3 months, we hand over our one share to our counterparty. We receive the $43 that we've agreed upon, and we owe $40 that we've borrowed times E to the 0.05, which is the interest rate, times 3 over 12. That's 3 months over 12 months, so 3 months of the year. And so what we owe back is $40.50. So there's clearly something wrong here in that someone has agreed to buy our product for $43 when we're able to essentially produce that and sell it to them at a cost of $40.50. Now, a lot of students are sometimes confused as to why we're worrying about the interest rate in here at all. Like, why did we borrow money at 5%? What if we just happen to have $40? Well, even if you have $40, there is always a time value of money. Even if you happen to have that $40 in your bank account, you would have been earning an interest rate on that. So we're charging ourselves an interest rate in order to make sure that the price is fair. So even with the fact that we've had to pay interest on our $40, worth of stock, the $43 clearly is not a fair price. Okay, well, let's look at another example here where, in this case, stock futures are now available at $39. So you know the underlying is trading at $40. You've called up your broker and they tell you that you can buy or sell futures at $39. So let's see if this makes sense, if there's any arbitrage opportunities. So step one is we borrow the shares and sell them for $40 cash, right? So we've received $40 cash. We're now going to put that in a bank account and we'll earn the risk-free rate of return, which in our example is 5% for 3 months. Then what we're going to do is we're going to buy a futures contract that covers 1 share. At expiration, no matter what happens with the price, we've bought a futures contract at 39. We've earned 50 cents in interest at the bank, which is 40 times e to the 0.5 times 3 over 12, 3 months out of the 12 in the year. And that gives us $40.50. So once again, we end up with a profit. In this example, we have a profit of $1.50. You can also see that this is a riskless outcome, assuming that we're able to trade the future and trade the underlying stock at the same time. We're locking in a profit each time when the futures are mispriced. So we have to ask ourselves, what is the fair value of the futures contract? And as we can see here, the only price the futures can be trading at in order to not provide an arbitrage opportunity is $40.50. And so that really then just leads us to what the formula for the price of a futures contract is. And that is, as shown on the screen here, F0, so the futures contract at time 0, the price of the futures right now, is equal to the S0, which is the spot price, the price of the underlying right now, times e to the RT. So it's a simple present valuing function is all we have to calculate in order to see what the fair value of the futures contract is. So as you can see, that holds up. It makes sense. If the futures contract was trading at any price other than that, there would be an arbitrage opportunity, and thus that formula holds for calculating the value of the futures contract. So there we go. So far, that's our first formula for the class. And as you can see, it's not a very complicated one. And you just need to get good at using your financial calculator in order to quickly price futures contracts once you know the interest rate and the price of the underlying. Now, the next slide here we're looking at is valuation exceptions, because that works very well for a very simple underlying. But what happens if we can't short sell the asset, for example? What happens if you have to pay money to borrow the share, which is a real life expectation? What happens if the underlying asset pays a dividend before maturity, if there's a cash flow associated with the underlying asset? And finally, what happens if the asset has storage costs? On top of that, with currency futures, if we're looking at a future on one currency priced in another currency, we have 2 risk-free rates. What do we do with those? And our final question is, what if there is a big shortage of the underlying asset mid-life for our underlying? And luckily, we have answers to all of these questions. So all we have to do, if we look on the next slide, you can see that we just have to make some small modifications to our formula that we've just learned in order to take into account all of these issues. So the first one here, if there's a dividend been paid on the stock, all we do is we subtract that dividend in the present valuing. So we'll say if the risk-free rate was 5% and there's a 4% dividend yield on the underlying asset, we just have 5% minus 4% leaves us with 1%. So it would be forward equals spot times e to the 1% to the t. With a storage cost, we simply add in the storage cost in the same place. So it's e to the r plus u, where u is the storage cost. For foreign currency futures, we use R minus RF, so the domestic rate minus the foreign currency interest rate. And finally, a convenience yield asset is R plus U minus Y to the T. So that's how we deal with that concept of a big shortage. Now, once again, if you take a look at your textbook, there's a much bigger explanation of what convenience yield is. But a quick explanation is that users of a consumption asset, an asset that people actually need, may obtain a benefit from holding the asset rather than holding the future. So the classic example of this is heating oil in the winter, in that it's all very nice saying that owning a futures contract gives you the same economic effect as owning the underlying, except when you need to heat your house, you would happily pay more for the underlying asset than you would for the underlying asset with delivery in, we'll say, 3 months when the winter might be over. So that's what we call convenience yield. Now, on the last slide, you probably noticed at the bottom it said that Y is backed out of market prices. So convenience yield isn't something that we can throw into the formula, because we can never tell how much more people are willing to pay for the convenience of having the asset now rather than at some point of time in the future. And so what we do is we look at the futures price and we look at the price of the underlying asset, and we can back out what convenience yield is. So you'll never, convenience yield is backed out of the formula. It's not something that we can necessarily put into the formula in order to calculate a fair value for an asset with a shortage. So our next slide now, basis of futures and forwards. The term basis is used, it's the term for the difference between the spot price and the futures or forward price. In the very simple example that we saw, the very first one where there was no dividend yield, no convenience yield, no complicating factors, it's simply that present valuing factor. There will usually be a different basis for each delivery month for each underlying, and basis is defined as spot price minus futures price. Sometimes we use futures price minus spot price though, but the basis is simply the difference between the price of the future and the price of the underlying. So in our first example, where we said that the fair value of the future was $40.50 and that the underlying was trading at $40, therefore the basis would be 50 cents. Now on our next slide, we have a little chart, and it shows that as delivery approaches, futures prices converge towards the spot price. And this is quite simply that all of those factors are disappearing. The present valuing factor is disappearing, and so on. Even things like storage cost, convenience yield, and so on start to matter less as we get closer to maturity. And it's pretty obvious that at maturity, we'll say a future that expires today is no different than the spot price, right? Because a future that gives you the delivery today is the same as just buying the underlying asset. Buying a future is just sort of a complication on the way to buying the underlying asset. So it's obvious that at maturity there should be no difference between the futures price and the price of the underlying. And so as you can see there in the chart, no matter what happens with the price of the underlying, as you can see there, the spot price is going up and down. The futures or forward price is going up and down roughly in line with it. But as time is passing, as we're getting closer to maturity, that is narrowing out. On our next slide, we have an explanation. The value of a futures contract at inception is equal to 0. And that essentially just means that when we don't know what's going to happen with the underlying, when we've bought, we'll say, a futures contract on an underlying, we don't know what will happen with the underlying. Now, a day or two later, once the underlying has moved, that futures contract will have taken on a value. So our formula here, F is equal to S0 minus K e to the RT. What that is really saying is that the value of the futures contract midstream is the difference between the spot price right now and the strike price, which was the agreed upon price of the futures contract when we entered it with that present valuing formula. So e to the RT is just present valuing that. So the difference, there is a difference between a futures price and the value of a pre-existing futures position. So, and that's really just because the strike price will be different. So our next slide now is on contango and backwardation. Contango is when the futures price is greater than the expected spot price, and backwardation is when the futures price is less than the expected spot price. So really, this usually relates to things like cost of carry. It relates to storage costs, convenience yields, things that will cause underlying to either trade in contango or backwardation. In most contracts, they have a way that they typically trade, like they might typically trade in backwardation, but once in a while they can then flip to contango based on market dynamics at that given time. Okay, so we'll move on from that and we'll move on to the uses of futures and how people might use them hedging. So our first question here is, should companies hedge? And we'll take the example of a British company that manufactures goods. They buy all of their supplies locally in British pounds. They sell all of their goods to British customers in British pounds, and they pay their staff in British pounds. And we ask, does this company have any foreign exchange risk? When we look at this, if you think about it for a few minutes, you'll probably say, well, no, they don't, because, everything they do is GBP, it's British pound denominated. So there's no foreign exchange exposure that this company has. And so, we can safely say that they don't have foreign exchange risk or any need to hedge. But if we take a step back, we can think, well, what about the companies they compete with? And if their biggest competitor is, we'll say, for example, a French company that manufactures the same goods, but they buy all of their supplies in euros, sell their goods in Britain to the same companies as our British company, and they pay their staff in euros, you can see that if there's a fall in the price of the euro against the pound, that this French company will suddenly have an advantage. They'll be able to sell their product cheaper than our British company. So in truth, our British company, without really realizing it, because they have one foreign competitor, actually do have some foreign exchange risk. Now, once we know that they do or they might have foreign exchange risk, our next question is, well, should they hedge this risk? And the truth is probably not, because obviously most companies will probably have competitors from all different countries in the world, and it's very difficult to know which currency you should hedge or why. So for our company in this example, they probably won't and probably shouldn't hedge foreign exchange risk, but it is just a thought experiment. It's worth thinking about this in understanding how companies might be exposed to factors that they may not initially realize that they are. So let's move on to our next slide, hedging using futures. And so short futures hedges are used when the company already owns the asset. So early on we talked about a corn farmer, and that farmer already owns, in our example, a field full of corn. So he is worried about the value of that corn that he already owns falling. And so in order to hedge against a fall in prices of corn, he would be using a short futures hedge. He would be shorting corn futures in order to hedge the exposure that he has, which is long corn in his field. Now, the opposite example of that would be our breakfast cereal company. They have a need to buy corn at some point in the future. And so in order to hedge, would be taking the opposite hedge. They would be buying corn futures. You can see in our slide there the other examples, like airline company. They might need to hedge their exposure to airline fuel, and so on and so forth. Our next slide is on the beta of stock portfolios, and beta can be calculated against anything. But in our example, when you are hedging, if you were hedging a stock portfolio with S&P 500 futures, for example, you would need to firstly hedge out the market exposure of that by looking at the beta of your portfolio. Now, if the beta of your portfolio is 1, meaning that it moves roughly in lockstep with the S&P 500, your calculation is rather easy. But we'll say, for example, if you had a high beta portfolio, what that means is that your portfolio, if your portfolio has a beta of 1.5, if the S&P is up 1% on a given day, you would expect your portfolio to be up 1.5%. Thus, if you're hedging with S&P 500 futures, you're going to need to sell more S&P 500 futures in order to hedge this beta. So our formula here, N is the number of futures required to hedge, is equal to beta times VA over VF. VA is the value of your stock portfolio, and VF is the value of one futures contract. So in order to work out how many futures you need to sell to hedge your portfolio of stocks, you need to take beta into account, and once you punch the numbers into that formula, you should be able to calculate your hedge. Well, that is the end of class number 1. We will move on to new derivatives next week. Hopefully you guys found this interesting, and talk to you soon. Bye.